There's a four-stage process that has already confiscated billions in savings from ordinary people in two Western nations. And right now in 2025, that same framework is built into law in the United States, the UK, Canada, Australia, and across the European Union, waiting to be activated the moment the next banking crisis hits. In March 2013, Cyprus became the testing ground. Banks closed, ATMs shut down, and when they finally reopened, 47.5% of all deposits over $100,000 were gone. Seized, converted into worthless bank shares. Citizens woke up to find their life savings had been confiscated to save the banks. 2 years later, Greece followed the same script. Banks closed for 3 weeks. Capital controls locked money inside the country. Citizens could withdraw $60 per day. 60, that's not a banking system. That's a prison, and here's what should terrify you. Both of these weren't accidents, they weren't emergency measures. They were the planned implementation of a new global banking framework that treats your deposits not as your money, but as the bank's money, as unsecured debt that can be seized to recapitalize failing banks. This framework has a name, it's called bail-in, and it's already law in the United States. This is the story of how the rules changed, how two countries became the guinea pigs, and why your savings are next in line when the system breaks. And it's not a question of if, it's a question of when. Before we walk through the 4 stages, you need to understand what fundamentally changed in the global banking system after 2008. What happened in Cyprus and Greece wasn't random. It was the implementation of a coordinated international policy. After the 2008 financial crisis, governments around the world spent trillions bailing out banks. Taxpayer money flooding into failing institutions. The public was furious. Politicians promised it would never happen again, and they meant it. But not in the way you think. The solution wasn't to make banks safer. The solution was to change who pays when banks fail. Instead of taxpayers funding bailouts, the new system forces bank creditors to absorb the losses. That sounds reasonable until you understand what it means. When you deposit money in a bank, you're not just storing it there. Legally, you become an unsecured creditor of the bank. The money isn't yours anymore, it's the bank's. They owe you a debt. And under the new framework, when that bank fails, your deposits can be seized to recapitalize it. This is bail-in, the inverse of bailout. In 2011, the Financial Stability Board, an international body that coordinates financial regulation across countries, published something called the Key Attributes of Effective Resolution Regimes. This document laid out the blueprint for how failing banks should be resolved. And at its core was the bail-in tool. By 2014, the European Union had implemented this through the Bank Recovery and Resolution Directive, or BRRD. By 2010, the United States had already codified it in Title II of the Dodd-Frank Act, called the Orderly Liquidation Authority. The language is bureaucratic. The mechanism is simple. When a bank fails, instead of the government stepping in with taxpayer money, the bank's creditors, including depositors above the insurance limit, lose their money to keep the bank afloat. This wasn't theory, it was policy. And Cyprus and Greece became the first places where the world got to see exactly how it works in practice. Let's walk through it, stage by stage, because this is the exact process that will be followed the next time a major banking crisis hits. Stage 1. The warning signs appear. Economic crisis creates instability in the banking sector. In Cyprus, it started in 2011. The Greek government defaulted on its debt. This was a massive event because Greek sovereign bonds were considered safe assets. Banks across Europe held them. Cypriot banks were heavily exposed. They held billions in Greek bonds. When Greece restructured its debt, taking losses of 50% or more, Cypriot banks lost over $4 billion. That's 22% of Cyprus's entire GDP, wiped out in an instant. The banks were insolvent. They didn't have enough capital to cover their losses, and the Cypriot government didn't have enough money to bail them out. Cyprus's banking sector was enormous, over 6.5 times the size of the country's GDP. It had become a financial center, attracting deposits from across Europe, particularly from Russia. Wealthy Russians used Cyprus as a tax haven. Low taxes, access to the European banking system, high interest rates on deposits. By 2012, Cyprus's two largest banks, Bank of Cyprus and Laiki Bank, were on life support. They were borrowing emergency liquidity from the Central Bank of Cyprus just to stay open. And the European Central Bank started to lose patience. Greece followed a similar trajectory. In 2015, the newly elected government of Alexis Tsipras, a leftist who ran on an anti-austerity platform, immediately clashed with European creditors over the terms of Greece's bailout. Negotiations broke down. The bailout extension expired, and the ECB announced it would not increase emergency liquidity assistance to Greek banks. This is the trigger. When central banks cut off emergency funding, the clock starts ticking. Banks have days, not weeks. Stage 1 is when the crisis moves from manageable to critical. The public doesn't know yet. But behind closed doors, government officials, central bankers, and international creditors are making decisions that will determine who loses money when the system breaks. Stage 2, capital controls and bank closures. The money gets trapped. Once the decision is made that a bank or banking system is about to fail, the immediate concern is panic. If people know their money is at risk, they'll try to withdraw it all at once. That's a bank run. And a bank run can collapse the entire financial system in hours, so governments move fast to lock everything down. In Cyprus, on March 15, 2013, banks were ordered to close. No warning, just closed. ATMs were shut off. The government announced it was a bank holiday. It lasted 10 days. During those 10 days, the Cypriot people had no access to their money. Businesses couldn't operate. Salaries couldn't be paid. Chaos. And then came the announcement. In exchange for a $10 billion bailout from the European Union, the IMF, and the ECB, Cyprus agreed to shut down Laiki Bank entirely and impose a one-time levy on all deposits. The original proposal was insane. It would have seized 6.7% of all deposits under $100,000 and 9.9% of deposits over $100,000. Even insured deposits, the ones supposedly protected, were going to be taken. The Cypriot parliament rejected it. There was outrage. People protested in the streets. But the pressure from Europe was relentless. The ECB threatened to cut off emergency liquidity entirely. Cyprus had no choice. On March 25th, a revised deal was reached. Deposits under $100,000 would be protected, but deposits over $100,000 would be subject to a bail-in. At Laiki Bank, all uninsured deposits were seized. At Bank of Cyprus, 47.5% of uninsured deposits were converted into bank shares. That's not a tax, that's confiscation. Greece's version of Stage 2 came in June 2015, after the government called a referendum to reject the creditors' demands. The ECB refused to increase emergency liquidity. On June 28th, Greek banks were ordered to close. They stayed closed for 3 weeks. Capital controls were imposed. Citizens could withdraw $60 per day. That's it. Foreign transactions were blocked. Businesses couldn't pay suppliers. People couldn't send money abroad. The economy froze. The government claimed this was temporary, but the capital controls stayed in place for 4 years. 4 years. Businesses that relied on imports collapsed. Tourism tanked because foreigners feared getting trapped with no access to money. The Greek economy shrank by another 25% during this period. Stage 2 is about control. Once the banks are closed and capital controls are in place, the public is locked in. There's no escape, and that's when the real confiscation begins. Stage 3, the bail-in. Your deposits are seized. This is the moment where the new framework shows its teeth. In a traditional bailout, the government would inject capital into the failing bank using taxpayer money. In a bail-in, the bank's creditors provide the capital by having their claims written down or converted to equity. The order is specific. First, shareholders are wiped out. Their shares become worthless. Second, bondholders take losses. Their bonds are written down or converted to shares in the recapitalized bank. Third, large depositors, those with uninsured deposits, are bailed in. In Cyprus, the mechanics were brutal. At Laiki Bank, all deposits over $100,000 were transferred to a bad bank and frozen. Depositors would eventually get pennies on the dollar after the bank was liquidated. At Bank of Cyprus, 47.5% of uninsured deposits were converted into shares. If you had $200,000 in the bank, $95,000 became shares in a bank that had just collapsed. Those shares were worthless for years. Depositors couldn't sell them, couldn't access that money. Just gone. The government and the EU called this fair. They said uninsured depositors were taking a risk. They said it was necessary to avoid a taxpayer bailout. But here's what they didn't say. Many of those depositors weren't oligarchs. They were small business owners, retirees, families who had saved for years. And 47.5% of their savings vanished overnight. Greece didn't impose a direct deposit levy like Cyprus, but the capital controls and the bank recapitalizations achieved the same effect. In December 2015, Greek banks were recapitalized again, shareholders were diluted, bondholders took losses, Depositors didn't lose money directly, but they couldn't access it freely. The capital controls made deposits functionally worthless. You can't spend money, you can't withdraw. You can't invest money, you can't transfer. For ordinary Greeks, the result was the same. Their wealth was destroyed. Stage 3 is where the theory becomes reality. The bail-in framework, written in dense legal language, becomes the confiscation of your life savings. And it's all legal, because the rules were changed before the crisis hit. Stage 4, the new normal. Control never fully lifts. After the immediate crisis passes, you'd expect things to return to normal. The banks reopen. Capital controls lift, life goes on. That's not what happens. The controls ease slowly, but they never fully disappear, and the psychological damage is permanent. In Cyprus, capital controls were gradually relaxed over 2 years. But even when they were officially lifted, nobody trusted the banks anymore. Deposits never recovered. Businesses that relied on international transactions stayed crippled. The entire Cypriot economy shrank by 10% and took years to recover. In Greece, capital controls were imposed in June 2015. They weren't fully lifted until September 2019. 4 years and 3 months. An entire generation of Greeks grew up unable to freely access their money. When the controls were finally removed, it wasn't because the banking system was healthy. It was because there was no money left to control. Deposits had already fled. Over 40 billion left the Greek banking system between 2015 and 2019. People withdrew cash and hid it under mattresses. Others moved money abroad illegally. Nobody trusted the system anymore. Stage 4 is the long-term consequence. Even after the immediate crisis ends, confidence is destroyed. People pull money out of banks. Economic growth stalls, investment dies. And the government has shown its willingness to seize private assets to save the banks. Once that precedent is set, nobody believes their money is safe. This is the reality of the bail-in framework. It's not a temporary emergency measure. It's a permanent shift in who bears the risk of bank failure. And Cyprus and Greece were just the test cases. The framework is global now, and it's waiting to be used again. Now let's talk about why this matters to you. Because this isn't ancient history. This is the current legal framework in every major Western economy. In the United States, Title II of the Dodd-Frank Act gives the FDIC, the Federal Deposit Insurance Corporation, the authority to resolve failing financial institutions through a process called Orderly Liquidation Authority. The language is almost identical to the European BRRD. When a large financial company is about to fail, the FDIC can be appointed as receiver. It can seize the company, transfer assets, impose losses on creditors, and yes, that includes depositors with uninsured deposits. Deposits over $250,000 are not protected. In a crisis, they can be bailed in. The FDIC and the Federal Reserve even published a joint paper in 2012 with the Bank of England, outlining exactly how they would coordinate cross-border bail-ins for global banks. It's called the Single Point of Entry Strategy. The plan is explicit. In the UK, the Banking Act of 2009 gives British authorities bail-in powers. In Canada, the budget of 2013 included provisions for bail-in. In Australia, the Financial Sector Legislation Amendment Act of 2018 implemented the framework. In the European Union, every member state has implemented the BRRD. This is not a conspiracy theory. This is public policy, and the mechanism is already built into law. The only question is when it will be used. Let's be clear about what this means in practice. If you have more than $250,000 in deposits in a U.S. bank, and that bank fails during a financial crisis, the FDIC can seize those deposits to recapitalize the bank. You don't get a vote. You don't get a warning. You wake up one morning and your money is gone. Converted into shares of a failed institution, the same shares that just became worthless. The same thing applies in every other country with this framework. Deposits above the insurance limit are at risk. And here's the terrifying part. The insurance limits haven't changed since the last crisis, $250,000 in the US or $100,000 in Europe. But the amount of money in the banking system has exploded. Central banks have printed trillions since 2008. That money is sitting in bank accounts. And when the next crisis hits, all of it above the insurance limit is exposed. Let me walk you through what the next crisis will look like. Because we know the script now, we've seen it twice. The warning signs are already visible. Global debt is at record highs. U.S. national debt is $36 trillion. Corporate debt is over $10 trillion. Commercial real estate is collapsing. Regional banks are holding billions in underwater bonds. Interest rates went from 0 to 5% in less than 2 years. That destroys the value of long-duration bonds. Banks that loaded up on treasury bonds and mortgage-backed securities when rates were low are now sitting on massive unrealized losses. We saw this in March 2023 with Silicon Valley Bank and Signature Bank. They collapsed in a weekend. The FDIC stepped in. Depositors were made whole, but only because the government invoked a systemic risk exception. They bent the rules to avoid a panic. Next time they won't. Next time the bail-in framework will be used. Here's how it will play. A major bank will announce losses. Maybe it's a commercial real estate collapse. Maybe it's a derivatives blow-up. Maybe it's contagion from a European or Chinese bank failure. The Federal Reserve will provide emergency liquidity. It won't be enough. Depositors will start withdrawing money. The bank run begins. The FDIC will close the bank on a Friday night. By Monday morning, capital controls will be in place. Withdrawals will be limited, transfers will be blocked. And then the announcement, uninsured depositors will take losses. Deposits over $250,000 will be converted to equity in a bridge bank. The government will call it fair. They'll say it protects taxpayers. They'll say the rules were always clear. But millions of people will wake up to find their savings gone, and there will be nothing they can do about it. Because the law allows it. The framework is already in place. The precedent has been set. And the next crisis is not a matter of if, it's a matter of when. So what do you do? How do you protect yourself when the system is designed to confiscate your wealth? First, understand the risk. Any deposit over the insurance limit, $250,000 in the US, $100,000 in Europe, is exposed. If you have more than that in a single bank, you are an unsecured creditor. Your money can be seized. You can spread deposits across multiple banks to stay under the limit at each institution. That's cumbersome, but it works. You can move money into assets that can't be bailed in. Physical gold, real estate, Bitcoin, anything outside the banking system. You can hold cash, not ideal because of inflation. But cash can't be bailed in. It can't be frozen, it's yours. You can use the CDARS system, the Certificate of Deposit Account Registry Service, which spreads large deposits across multiple banks to stay under FDIC limits at each one. But here's the deeper truth. If you're worried about a bail-in, you're worried about systemic collapse. And in a systemic collapse, the rules change. Capital controls can block all withdrawals. Gold can be confiscated like it was in 1933. Bitcoin can be regulated or banned. Real estate can be taxed into oblivion. When governments are desperate, nothing is off limits. The only real protection is to be mobile, to have assets in multiple jurisdictions, to not be entirely dependent on any single system. But most people can't do that. Most people have their wealth tied up in a house, a retirement account, and a bank account. And when the next crisis hits, all of it will be at risk. The bail-in framework ensures that. Let's go back to the core reality. What happened in Cyprus and Greece wasn't a fluke. It was a test, a proof of concept. The international financial establishment wanted to know if they could seize deposits without triggering a revolution. And the answer was yes. There were protests, there was anger. But there was no revolution. People accepted it, they had no choice. The banks reopened, life went on, and the message was sent to every government in the world. You can confiscate deposits, the public will complain, but they'll accept it. The Financial Stability Board reviewed the Cyprus bail-in. They called it a success. They noted lessons learned. Mainly, don't seize insured deposits. That caused too much outrage. But uninsured deposits, fair game. The framework has been refined since then. It's more sophisticated now, more legal safeguards, more procedures, but the core mechanism is the same. When a bank fails, creditors pay, and depositors are creditors. The FDIC has run simulations. They've wargamed how to implement bail-ins on major U.S. banks. They've coordinated with international regulators to ensure cross-border institutions can be resolved without triggering contagion. This isn't hypothetical, it's operational. We're one crisis away from seeing it deployed at scale. And the crisis is coming, it always does. The financial system is more fragile now than it was in 2008. More debt, more leverage, more interconnection, and this time there's no easy way out. Interest rates can't go to zero again. They're already too high and causing pain. Governments can't print unlimited money. Inflation is already a problem. And the political will to bail out banks with taxpayer money is gone. The bail-in framework is the only tool left. When the crisis comes, it will be used. Not because governments want to confiscate deposits, but because they have no other choice. The system is designed to fail, and when it does, your savings are the first line of defense. 2 countries, 2 crises. The exact same four-stage process: warning signs, bank closures and capital controls, bail-in, and a new normal where confidence is destroyed and money never feels safe again. This isn't ancient history. This happened in 2013 and 2015 in Western, developed, European Union member countries, countries with functioning democracies, countries with rule of law. And it will happen again. The legal framework is already in place in the United States, the UK, Canada, Australia, Japan, and across Europe. The precedent has been set. The playbook has been written, and the only question is which crisis triggers it next. Maybe it's a commercial real estate collapse. Maybe it's a derivatives crisis. Maybe it's contagion from overseas. Maybe it's just the slow accumulation of unrealized losses, finally forcing banks to recognize reality. But it's coming, because the system is built on leverage, on debt, on the assumption that nothing will ever go wrong. And when something does go wrong, the bail-in framework ensures that you pay, not the banks, not the government, your savings, your deposits, your wealth. That's the new reality. And Cyprus and Greece showed us exactly how it works. If this woke you up to what's already built into law, subscribe. Because when the next banking crisis hits, you'll want to understand what's happening and why. The answers aren't hiding in the future. They're written in the past. And I'll show you where to look.